Hey there, thanks for tuning in. Welcome to Investing in Germany. And today, let's have a look at the recent economic forecast submitted by the European Commission for the Euro countries, which also includes Germany. The report does not provide any new information compared to the data which I provided in my earlier videos. So please do take some time and have a look at my previous videos. So let's quickly get into the topic here. So this is a fairly new document from the 11th of November 2022, which says Singles Day. So it's quite interesting. Anyways, so looking at the growth indicators, so we have the GDP growth, where the European Commission is forecasting a degrowth of minus 0.6% in 2023, which means that we are for sure entering into recession. So there is no more debate on that. And it's really clear that we will have really tough times next year in Germany. And 2024 is also not so interesting here. A growth rate of 1.4%. This is also something less compared to 2021 and 2022 GDP growth. The inflation is also not so really good. So they are projecting the inflation to be at 7.5% in 2023, which is almost 4 times the target inflation rate, which is 2%. So you can clearly see that there is a huge gap in inflation, and we are going to suffer next year as well due to the inflation. And the 2024, they are projecting it to be around 3%, which is also above than the target inflation rate. So we will have this high inflation rate more than 2 years. This is not going to be really good years to come. And unemployment rate is marginally going up in 2023. But then if you compare that to the 2021, we are slightly below. As you might have already know from my previous videos, so unemployment and the inflation is related through this Phillips curve, which says that if the unemployment is high, the inflation comes down. So we also need some higher unemployment level so that we can control the inflation. Here there is not significant increase to the unemployment. Let's see how it progresses with the inflation data. Going deep into the reasons why we are at this situation is, first of all, is all due to the disruptions due to the Russia and Ukraine war, which is not really going to an end at the moment. And also that the economic growth in 2022, what we are seeing here, the GDP growth of 1.6% is mostly due to the pent-up demand, which came in as the economy started opening up, and then the people came out and then spending like crazy. This will not move to the next years or next quarters, and therefore there is a clear tendency of degrowth in 2023. What I really like in this document is also that the European Commission is not sugarcoating the word recession, so they are clearly maintaining it as a recession. So this is quite good note for them. And then what is really very bad here is also that they also see there is a downside risk of the GDP growth in 2023 due to the energy crisis which we are currently seeing. If this keeps on progressing to the next years, and we will see much more degrowth compared to 0.6 in 2023. In other words, if the energy crisis doesn't get under control, then we can see further downward revision of the forecast for the 2023 year. Let's see how the German government tackles the supply of the energy and all those oil and gas commodities. The employment, what is really also concerning here is that the expectation in the ground has deteriorated in the recent months. So there is not much expectation for the people who are searching for a job, even though they are projecting that there is some shortages of labor. But then it's a bit more debatable. We have to see how it really progresses. Sentiment is really low in the market now. Moving down to the inflation, we are going to have 7.5% in 2023. That is clear. And the energy prices is going to keep the inflation rate at really high level in 2023 as well. And finally, coming to the energy measures, there looks to be some sort of planning going on where they are projecting the VAT tax reduction from 19% to 7% for those energy, as well as they are trying to tweak the income tax. So zooming out from Germany into the European area, this does not also provide much significant results. As you can see, almost all the economies or the markets within the European Union is projected to have really low GDP growth in 2023. The worst affected country here is the Germany, which is minus 0.6, and other countries which are also projected to shrink is Latvia, and also Sweden here. So we have to see how the IKEA is going to progress next year. Yeah, let's see. Coming back to the stock market performance in the last 1 week, even though we had really bad forecast coming in from the European Commission, you can see that DAX has really performed well. It's like gone up like 5.64 percentage. This is really crazy, right? And the 1 month performance is also really significant here at around 16.86 percentage. So the DAX is really doing well. One of the main reason here is that the US has reported their inflation rate recently, which was really good compared to what market was expecting, and also due to the news coming in from the Chinese economy. So let's have a look at those couple of data points. The USA reported their inflation rate for the October 2022, which was coming in at 7.7 percentage, which is really low compared to what the market was expecting. As you can see here, the market was expecting about 8 percentage and the reported was 7.7 percentage. So the market really got happy on this and really went and bought all the stocks available in the market. So that is why you see a really good jump in DAX as well as in S&P and all other indices around the world. At least from the American side, the inflation looks to be in control, or they're trying to get it under control with the recent increase in interest rates. We have to see how the European Central Bank's increase in interest rate is really coming into play in the next months in the European Union. The other news which really added stir to the market is the Chinese news coming in, where they are slightly easing those restrictions coming in from the zero COVID policy. They are sticking to the word zero COVID, but they are slowly coming out of the restrictions, and therefore the market is really happy here because all the supply chain constraints and stress will be eased, and also the Chinese economy will start to recover, which is then really good for the Chinese economy as well as for the international market. Hong Kong stock market really went 8%, so this is really crazy here. Thank you. Thanks for watching. See you in the next video.